Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Welcome back to Part 2. In this video, we'll look at the biggest risks investors worry about and what options exist if you're avoiding thermal coal. When fewer banks want the business, the remaining options often cost more. Higher interest rates, shorter loan terms, and limited underwriting can all reduce the value of a coal asset on paper. Insurance can become a bottleneck too. If a mine or plant can't secure affordable coverage, operations and expansion plans get harder. For public companies, limited financing can increase dilution risk. If debt isn't available on reasonable terms, a firm may issue more shares to raise cash. That can water down existing shareholders, even if the business is profitable in the short run. The biggest risks investors worry about with thermal coal. Coal investing looks less like buy and hold, and more like risk management. Some of the biggest threats are not about today's earnings. They're about how fast the outlook can flip. Investors tend to watch for a few return killers that can show up with little warning. Policy shock risk. A rule change can raise costs, limit output, or speed up closures. Refinancing risk. Debt that was easy to roll over years ago may now come with painful terms. Customer risk. A utility can reduce coal burn faster than expected if it adds gas, renewables, or storage. Reputation and mandate risk. Some funds must sell if a company crosses a coal revenue threshold. Those are broad categories. Two specific risks come up again and again. Stranded assets, when mines or power plants lose value sooner than planned. A stranded asset is easy to picture. Imagine a coal plant expected to run for decades. It closes early. The owner still has debt, cleanup costs, and contracts that don't disappear just because the plant stopped. Stranding can happen for several reasons. Tighter rules. Carbon costs. Cheaper power from other sources. Local opposition. Grid upgrades that reduce the need for coal baseload generation. Sometimes the trigger is a utility's new plan that favors faster retirements. Sometimes it's a regulator that refuses a permit extension. For investors, stranding shows up as write-downs, weaker cash flow, and pressure on dividends. A company can look cheap right before it has to admit its assets aren't worth what the balance sheet says. That gap between book value and real value is a classic way investors get trapped. Price swings and demand uncertainty can crush forecasts. Thermal coal prices can move like a storm front. Weather events can spike demand. Shipping disruptions can tighten supply. Geopolitics can reroute trade flows. Those moves can be real, but they can also be temporary. The risk is buying near a peak and assuming it's the new normal. When prices fall, earnings can drop fast, and so can equity valuations. Even strong operators can't fully control this because coal is a global commodity with many moving parts. High prices can also plant the seeds of lower demand. When coal gets expensive, utilities look harder at fuel switching, efficiency upgrades, and new generation builds. A short period of high prices can push long-term customers to sign contracts elsewhere, which lowers future demand and makes the next downturn sharper. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.